This slide may be hard to read. I apologize. I copied it here kind of at the last minute. But look, with the Michigan surveys came out today. And, a couple interesting things of note there. The consumer sentiment came in less than expectations. But the inflation expectations, the 1-year median inflation expectations, which is what this chart is showing here, surprised to the upside. And the survey was looking for 3.3% 1 year out inflation expectations. It came in at 4.3%. The new Trump administration and Scott Bessent, the Treasury Secretary, I mean, they are trying really hard to bring inflation expectations down and to bring the 10-year yield down. As Scott Bessent has said, that's their objective, is to bring down the 10-year yield and to bring down the whole curve by lowering inflation expectations. Key aspect of this are the three arrows plan. I'm not going to go into the three arrows exactly, but it's the through the Department of Government Efficiency, the deregulation, the policy on energy, getting energy oil equivalent production that includes natural gas up. All these things are designed to reduce inflation expectations, but what's the problem? Inflation expectations are not really coming down. Let's look at the next chart here. So this is where I have been showing this, and I've updated it again here. This is where we look at the mean 5 to 10 year inflation expectation in the Michigan survey, and it is blown out to a new high level of 6.9%. Long-term inflation expectations, according to the survey, have gone to their highest level. So what's going on here? And at the same time, we're looking at the inflation expectation. People call it inflation expectations. The TIPS 10-year break-even CPI rate. So in the 10-year embedded in the TIPS market, Treasury inflation protected securities is the market expectation, not for inflation exactly, because it's not inflation. It's CPI. It's a government statistic. It's the market's expectation for what government statistics are going to show inflation to be over 5 to 10 years. It's called the 10-year break even. And people call it inflation expectations, but it's not true consumer inflation expectations. For consumer inflation expectations, look at that red line. That's where the average consumer inflation expectations are today. So you have to admire that the Trump administration and Bessent, Treasury Secretary Bessent for having this bold plan to bring down inflation expectations. But I have to say, the market is not really believing it yet. And importantly, you got some really smart money managers, some really smart hedge fund managers like Paul Tudor Jones and Stan Druckenmiller, who say we're only in the seventh inning here. And what the seventh inning for what? The seventh inning for rising interest rates on the long end of the curve. These guys are short the long end of the Treasury curve. Now maybe they've changed their positions and they can reverse their position, but heck, if I was looking at this information, and 10-year yields are going up today, by the way, if I was looking at this information, I wouldn't be reversing my position if I were those guys. And I really do, have high hopes for Trump and Bessent and what they're trying to accomplish. But we still have some major imbalances. And what are the most glaring imbalances besides this still high inflation expectations? Let's go on to the next. Well, look, it's the Magnificent Seven. It is large cap growth stocks. It's mega cap tech stocks. I've shown this chart before, and I'm going to keep showing it because this is the biggest imbalance in the entire financial markets today, and people need to understand this. They've they've been pounded into submission to believe that you got to buy index funds and you have to and it's okay to own, and you want to stay along the Magnificent Seven. But look, the Magnificent Seven combined enterprise value to GDP is recently peaked out actually on 12/24 on December 24th, which by the way is the top in the Magnificent Seven so far. And it's been an orderly correction so far, but we've seen 1 or 2 days where some of the stocks have some pretty interesting down moves, like whether it's Microsoft or Apple or Nvidia or Google recently, even Amazon in the aftermarket last night and today is why is this an imbalance? Well, 62% of enterprise value to GDP. This is these companies are the largest market cap companies in the world, and for them to continue to grow at a rate that it exceeds GDP is simply impossible. It's just simply impossible because these companies are already too big of a portion of GDP, and there's too much competition, especially with AI. Look at what DeepSeek just proved with China DeepSeek coming out and proving that some of the business models that many of these companies had are not going to, they're not going to be able to maintain the high prices for their AI software. When you have these competitors coming in with open source solutions that are much cheaper, but so why is 62%, you might, it's a big deal, so what? These things keep growing. AI is wonderful. Well, AI is wonderful, and it's a great thing for the economy longer term. It's not a great thing for these stocks that are massively overvalued and facing huge competition and huge capex expense. Their growth rate is slowing. Their growth rate cannot exceed that of GDP, and yet they're all priced as if they're going to continue to grow at this bubble growth rate because of this AI hype. It doesn't happen. So let's look at what happens when this starts to crumble. Let's compare it to the tech bubble in 2000. Let's keep going here. What happened? So this is the top 10 stocks at the tech bubble in 2000. We were just looking at 7 stocks below. The 10 stocks collectively, the largest tech companies at the peak of the tech bubble in 2000, they only got to 30% enterprise value to GDP before we reached the unsustainable growth rates and the unsustainable capex spending. And the internet was wonderful. The internet was a huge revolution, just like the AI is going to be a revolution now. But it opens up the competitive field for new companies, for disruption, and what happened? We had the tech bust, and collectively, look, the market cap and enterprise value of these companies would fall, like 70+% from 2000 to 2002. How can that happen? Why is that comparable? Well, it's the capex cycle. It's the same phenomenon that's happening today. Let's keep going. So Nvidia today is the biggest supplier to the hyperscalers, right? Just like Cisco was the biggest supplier to the hyperscalers at the peak of the tech bubble in 2000. But Nvidia is a bigger bubble. It got to 12.4%. It just recently became the largest market cap company in the world. Got to 12.4% of GDP. Cisco only got to 5.5% of GDP when it was the largest market cap company in the world at that time. But what happens? What happens when the hyperscalers can no longer, when their business models don't support continuing to spend at the incredible growth rates on capex? You get the peak of the cycle like you did in 2000. Let's look at some more of those comparisons. Go on to the next. So who were the top vendors to the year 2000 hyperscalers? It was Cisco, it was Sun Microsystems, it was Lucent Technologies. Collectively they reached a $942 billion combined market cap back in 2000. These stocks would fall, just these three big technology provider companies would fall 90% in just 2 years. Their market cap. Why? Because we had the tech bubble peak. That's the spending sustainability just could not continue. Let's look at the next slide. So who were the hyperscalers then? Today, the hyperscalers, by the way, are Amazon, Microsoft, Google. Those are the three cloud hyperscalers. All right. There's also Meta is a hyperscaler. They have a different business model. But these are the ones spending the massive amount of CapEx today. Well, who were the companies spending the massive amount of CapEx back in Y2K? It was AT&T, SBC Communications, WorldCom, Quest. They were the largest spenders. Same phenomenon as the cloud hyperscalers today, Amazon, Google, and Microsoft. They were building out the infrastructure. Everyone was going to come to them to subscribe to internet service. What happened? Well, WorldCom and Quest both went bankrupt. AT&T is still around and has merged with SBC, but these companies, look at the red line. They collectively also went down about 80%. Like I said, two of them went bankrupt, but the rest of them, went to zero. The rest of them went down, about 80%, and the AT&T and the SBC, that's the red line. Look at the red line of the market cap. Why? Because CapEx peaked. So we just heard that Amazon's going to spend like $100 billion. We've heard Microsoft reiterate their spending on growth on CapEx this year. We heard it from Google as well, from Meta. Well, that's great for NVIDIA, right? Well, yeah, it's good for it's been great for NVIDIA, but it's unsustainable. It's an unsustainable growth rate of CapEx, and the growth rate is already decelerating. The growth rate is already for CapEx is already decelerating, and it's supposed to decelerate even more into 2026. Look, there's it's NVIDIA is the in the same way that Cisco was the dominant vendor for routers that were the backbone of the internet in Y2K. NVIDIA is the dominant chip in the data center. They've had incredible margins, incredible demand. The demand is continuing for now, but how are these companies going to get a return on that investment? How are the hyperscalers going to get the return on that investment? These hyperscalers back in Y2K, they weren't able to get the return on that investment. And look at what happened to their stocks. It's because there is competition there, and there's so much competition from venture capital funded new AI companies. Look, NVIDIA has competition as well from other semiconductor companies, from a company called Cerebras, which is a whole new type of chip design. Their chips are 10 times more powerful for data center computing than NVIDIA's, and there is competition out there. I talk about this because this is the biggest imbalance in the world today. The Magnificent Seven stocks, they already peaked out on December 24th. Whether it's going to be an orderly rotation out of these companies and into other higher growth, lower multiple companies that are beneficiaries of the new Trump administration rebalancing plan, economic rebalancing plan, reindustrialization. Um, you know, there will be a rotation. Can it be an orderly rotation, or can it be more of a disorderly rotation? Remember the first problem that I showed: increasing inflation expectations. Okay, this problem has not been solved yet. So what would help the Trump administration and the Biden administration more than anything else? And that would be that would be a much more significant stock market correction in the Mag 7, in tech stocks in general, in the large cap growth stocks and mega cap tech stocks. That is what could actually bring inflation expectations down. But until we see that, it is just this enormous imbalance, this enormous bubble that we're in today that is twice as big as the tech bubble in 2000. I am personally very confident that we will see a reconciliation in this bubble